What's up guys and welcome back to Wall Street Millennial. The GameStop short squeeze and crazy price action over the past month has shaken both the WallStreetBets community and the mainstream media. Many view this saga as an epic battle between the individual retail investor and multi-billion-dollar hedge funds. While many in the financial elite and establishment have condemned the short squeeze and WallStreetBets, the Reddit forum has found some high-profile allies in billionaires Elon Musk and Chamath Palihapityia. On January 26th, at the height of the short squeeze, Chamath tweeted that he bought about $125,000 worth of GameStop calls. This was a relatively small investment compared to his billions, but it was a significant gesture showing his support of WallStreetBets and the retail investors driving the rally. It also poured more fuel onto the fire of the GameStop rally. The next day, he went into the lion's den of CNBC to defend WallStreetBets users.
Hi, Scott. How are you?
I'm good, thanks. So you tweeted yesterday that you bought $115 calls in GameStop. Can you tell me what your position is as of this very moment?
Yeah. Can I tell you a little story before all of that, or no?
Why don't you tell me that first, and then we'll go from there.
So this morning I woke up after spending all last night in WallStreetBets, reading about all of this stuff. I ended up closing up my position this morning, and I wanted to announce that I'm taking all the profits that I made, plus my original position. So I'm going to take $500,000, and I'm going to donate to the Barstool Fund for small businesses. But I really want to tell you, beyond the $500,000 donation or the money that I invested, which was, not a huge amount in the grand scheme of that stock or the entire market, what I learned, because I think what I learned over the last couple of days is important for everybody that's watching CNBC.
And that is?
I think that what you're seeing is essentially a pushback against the establishment in a really important way. You have a lot of people, and I would encourage anybody who is dismissive of this thing to go into WallStreetBets and actually just read the forums. And I think that you're going to see three kinds of posts. The first kind of content are a lot of people doing some incredible fundamental diligence on companies, trying to think about long-term value. And in my opinion, many of them are doing as good and, frankly, a better job than a lot of hedge fund analysts that I work with. That's number one. The second are a lot of people who believe that, coming out of 2008, what happened was Wall Street took an enormous amount of risk, and they left retail as the bag holder. And a lot of these kids were in grade school and high school when that happened. They lost their homes. Their parents lost their jobs. And they've always wondered, why did those folks get bailed out for taking enormous amounts of risk and nobody helped and showed up to help my family? And then the third thing is a realization that instead of having idea dinners or, quiet whispered conversations amongst hedge funds in the Hamptons, these kids have the courage to do it transparently in a forum. And I'm not saying all of it is perfect by any means, but I think it takes an enormous amount of faith in the system to be that transparent, to talk about things, and then for each individual to make their own mind up and to do things, whether it's to buy and to sell.
He says WallStreetBets users perform fundamental due diligence on companies at the same level as hedge fund analysts, and it's completely legitimate for retail investors to talk to each other in an open forum like Reddit. Furthermore, he paints the GameStop saga as an uprising by the retail investors against the financial elite, who have undue influences over the market. But whenever you see a billionaire preaching on TV, you have to do some digging to see if his motives are purely altruistic or if he has ulterior motivations. In a recent Bloomberg interview, famous short seller Carson Block suggests that Chamath is only hopping on the GameStop bandwagon to build credibility with retail investors so they will buy into his SPACs.
Is this shortening your reports, using more video, putting yourself out on Zero's TV isn't necessarily going to change this impression people may have, Carson, that you're part of some financial establishment, is it?
I mean, I love it. Where do I start? Okay, so we have Chamath, or as I call him, SPAC Jesus, out there railing against short selling, and others saying, oh, these guys are the establishment. I think Chamath and many of these people probably have weekly meetings with Goldman Sachs and Credit Suisse, which, by the way, are two companies that have told us in the past to go F ourselves. In fact, with Goldman, it was an annual ritual. Somebody would call up, hey, I noticed you don't have sales coverage here. Would you like some? Sure, let's go through the process. 1 week later, bankers, Asia, reputation risk. I'm sorry, man. So when we get tagged as establishment, I mean, you can't be more inaccurate than that. I mean, it's almost funny if it weren't for the fact that I now have all these people like trying to troll me through direct message because I'm establishment. So
he starts off by saying, as an activist short seller, he is actually shunned by the elite Wall Street investment banks such as Goldman Sachs. Activist short sellers often get sued by their targets, and the banks fear the reputational risk of being associated with them. He also points out that Chamath likely works with investment banks to source his SPAC targets and bring them public.
Okay. I mean, look, man, it's just we're the ones calling out the excess in the bull for years. So I know it's not true.
No, that's fair. It's certainly a fair representation of how you feel. That much I'm absolutely certain of. You have to agree at the same time, there is a palpable sense of anger out there. And however misdirected the anger may be, it exists. So to the degree that the day trading army on Reddit is channeling some anger, where should this anger be directed? Who are the villains in this story?
Look, this anger, okay, I had not gone to WallStreetBets until a week and a half ago. So I'm not an expert on WallStreetBets. I'm not going to pretend to know, understand what they're thinking, specifically. But from my perspective, people I know, everybody is angry. I mean, COVID, and my family and I are far better off than most. But when I see the sacrifices my kids have to make, other people's kids who have it much worse, I mean, I have, over the past several months, I have found myself doing things that I have not done since adolescence, like taking objects and slamming them repeatedly into the ground out of frustration.
It's not just the frustration with COVID, though. There's a sense of frustration, anger over, and a feeling, let's say, that the market is rigged, right? That the cards are stacked against the retail investor, and they see hedge fund managers who short stocks as their enemy. That's the anger I'm talking about. Where should that anger be channeled?
The Bloomberg host makes a good point that many retail investors feel the short-selling hedge fund manipulates the market at the expense of individual investors. At its peak, GameStop's short interest was above 100%. It's crazy that it's legal to short more than 100% of a company. Short sellers were literally shorting the same shares multiple times. This is what put GameStop in such an unstable position in the first place. Also, the release of public short-selling reports can be used to push stock prices lower in favor of the short position.
But that's where I'm kind of questioning that narrative. Is it really anger that there's a hedge fund out there named Melvin Capital that's short stock, or is it just it's a feeling of anger in general, and anything can set it off in any given direction? I mean, I don't know the WallStreetBets psychology. But I feel like we are, as humans, when we get together in a mob, right now with all this anger, it can be directed anywhere. And that's why I'm really, that's what really upsets me when I look at SPAC Jesus and other fake populists, because they seem to be saying like, yeah, take your anger and buy what I'm selling, man. That's like giving it to the man, that's giving it to the establishment. And so I just feel like there's anger, and it can go in any direction. It went at Melvin, it went at Andrew, and next week it can go, at Kamala Harris. I mean, who knows where it goes next?
Carson Block makes a couple significant points here. First, he says he thinks there is a general anger around issues of wealth and income inequalities, which have gotten worse during the pandemic. This is a broad-based problem and is not really the fault of short sellers. For example, billionaires like Jeff Bezos have gained trillions of dollars of wealth during the pandemic, while mom-and-pop retail establishments are forced to shut their doors permanently. He again reiterates that he thinks Chamath Palihapityia, who he calls SPAC Jesus, is just trying to take advantage of the GameStop rally to ultimately promote his SPAC deals. So now let's take a look at the other side of the aisle, where we have Chamath Palihapityia, the billionaire investor who famously defended WallStreetBets. One of the main complaints against Chamath is that he is supposedly a fake populist and actually profits off the same retail investors that idolize him. So let's take a look at how much he's hyped his SPACs over the past couple years. These arguments don't reflect our opinion on Chamath or the state of the investing world. This is just laying out the arguments for and against the idea that Chamath is a man of the people. Our hope is that this will spark a discussion in the comments section about who is right, Carson Block or Chamath. In September of 2020, Chamath announced $1 billion SPAC deal with Opendoor, which is a real estate company that aims to make it easier for people to sell their homes quickly. They use a proprietary algorithm to automatically offer a cash price for your home, then do some fix-up and sell it for more money than they bought it for. What they do is actually pretty interesting and seems like it could really disrupt the residential real estate industry. Chamath seems to agree. Here's what he had to say about the company.
What's the news?
Andrew, well, thanks for letting me do this with you guys. The news is that IPOB is merging with Opendoor, and Opendoor will be going public. This is the largest online consumer real estate business in the United States. It's doing something really incredible. And what I wanted to do was take an opportunity to give the viewers a sort of behind-the-scenes look at how we decided to do this investment. It's more than $1 billion. It includes ourselves, as well as a bunch of very well-known other co-investors.
Right off the bat, he definitely is very complimentary of Opendoor, which is understandable since he was in charge of the deal, so it'd be weird if he didn't say good things about it.
And so I think it's important first, I wanted to just take a step back for you and talk about what this whole craze around SPACs, but specifically what my goals were with IPO 2.0. The reality is that a lot of investors are really shut out from the growth that exists in Silicon Valley and tech businesses. But what I'm trying to do is really democratize that access, find these iconic businesses, help them get public, enable them to grow for long periods of time, and really help build a legacy business. Because if we as investors can be a part of that, then we can basically share in those gains as well.
So now he's talking about how his SPACs democratize access to investing in ultra-high-growth Silicon Valley tech companies that traditionally were only available to venture capital and private equity shops. That's sure to pique the interest of retail investors.
So the setup is that. And so what we did was we started to look across a whole bunch of industries. And one industry that jumped off the page was consumer real estate. And the reality is that in the last 20 years, but even specifically in the last 6 months, everything that could be bought and sold online has moved online except that. And real estate is interesting because this is a category that touches every single American. This is the pillar of the American dream. 68% of Americans own a home. 32% probably want to at some point. 5 million homes are sold every year. This is the largest undisrupted market in the US. It's $1.6 trillion. But despite that, it's completely fragmented, it's low convenience, it's low trust, it's low NPS, and a third of the people in the marketplace actually only do it part-time. And so this is where we found Opendoor. And what they have done is something really incredible. And we think that they're building what we love to call a virtuous cycle.
So now he's basically saying how the digital revolution has seen all classes of transactions go online, except the buying and selling of houses, and how archaic the current system is. Opendoor is making a foray into bringing this industry digital, and that's great for investors.
So how does this work? You as a consumer can now go to opendoor.com, and within 24 hours, they will give you an all-cash offer for your home. And if you choose to sell within 3 days, you can sell your home. It's a really incredible experience, and so you can start to understand how they can build a really powerful competitive moat. Because the more offers that they're able to make, the more homes that they will buy and sell, which means the more markets they'll dominate, which means the more value-added services that they can automate online, for example, mortgages, title, escrow, all these things where you used to have hundreds of pages of documents they can streamline through a mobile app.
Opendoor actually seems like a really cool company that has the potential to disrupt a massive legacy industry. However, towards the end of the interview, you can see one aspect of the deal that should give investors pause.
Last year alone, they did $4.7 billion of revenue. And 2023, these guys will do almost $10 billion of revenue. If you take the playbook that they have and you just apply it to the markets in which they can expand in the US, at 4% share, this is a business that will do $50 billion of revenue. And it's a merger that really creates an opportunity for investors. We priced this deal at 1 times 2019 revenue, but it's also an opportunity for Opendoor to raise the money they need, fortify their balance sheet, and really create more value and scale.
They priced the deal at 1 times 2019 revenue. This seems like an extremely cheap valuation for a high-growth tech unicorn. However, you have to look at the details of how they recognize revenue. When Opendoor sells a home for, let's say, $200,000, they recognize that entire sale price as revenue. But in reality, they only make a commission of a few percent plus any appreciation in home value. Their gross margins will always be very low because they have to put up the money to buy the house in the first place. Because of these low margins, the deal looks much more favorable on price to sales than, for example, price to earnings, which is probably one reason why Chamath touts the price to sales metric. That would be like if eBay reported the full amount of all purchases on the platform as their revenue. It kind of is revenue, but not really. eBay only recognizes their 15% commission as revenue, not the total purchase amount of each item. Another one of Chamath's high-profile SPACs recently was from earlier this year when he announced that he would take the fintech firm SoFi public through another SPAC. SoFi is a new age financial services company that provides banking services, loans, credit cards, and other financial products to consumers. In his announcement on CNBC, he comes out guns blazing by referencing his early investments in Bitcoin, Amazon, and Tesla to prime the CNBC viewers with a favorable perception of his investing track record.
Yeah, a lot of the things that I do is try to look back at some of the best investments we've made, like Amazon and Tesla, and try to find patterns. And in this, what I was trying to do was map those patterns into financial services, just because we're at a point in time where it's clear that the banking infrastructure really isn't meeting the needs of US consumers. And so what I did was just kind of systematically try to figure out what was broken in banking, and then try to figure out which company was best representative of the solution that people wanted, which I can basically tell you is 3 things. People want low to no fees, they want fair and transparent lending, and they want a full suite of products so that you can basically have a one-stop shop. And SoFi basically was the top of the list when I looked across all the companies.
So according to Chamath, SoFi is the best company to solve all the major problems in the consumer banking industry and offers, quote, low to no fees, fair and transparent lending, and a full suite of products.
Yeah, in fact, the way that I think about this is I call this sort of the anatomy of innovation, right? You look under the hood of the best companies and the best CEOs, they do the following things. The first thing is, when you get a good product, you don't sit on your heels. You double down and you invest really aggressively to use technology to drive down the cost. And then what you do is you deliver those savings onto consumers. Then you launch many more products on top of the same platform. And the most important thing you have to do for people is to democratize access to a key resource. That's what Amazon has done. That's what SoFi is doing. Because the problem that banks have right now is after the great financial crisis, what they've done is they make money with hidden fees, with exorbitant fees. They have very restrictive lending practices. Ask anybody who's a middle-income person or a minority or a woman. It's incredibly hard to get access to the money you need to fulfill your dreams. And SoFi has fixed all these things, which is why I think it's such an incredible business.
What he's trying to do here is paint SoFi in the light of doing all things that the great companies and the great CEOs always do, using buzzwords like democratizing access to quality products, and providing capital to people to fulfill their hopes and dreams. These are all great things for SoFi to be trying to do, but it also seems perhaps on the optimistic side from the perspective of an investor. It remains to be seen whether SoFi will actually be able to execute on their growth plans over the next few years. Overall, Chamath's SPACs typically seem like they will be successful high-growth companies going forward. But is it really in the best interest of retail investors for him to be hyping them up so much before the deals? They haven't done that badly overall. For example, Clover of course shot up right after the deal was announced. While it has pulled back, it is still significantly above the original $10 price. And while Virgin Galactic fell 66% from its initial peak following the merger, it has since regained those losses and made investors a lot of money recently. So who do you think is right? Is Carson Block an establishment short seller, or is his ostracization from big Wall Street banks proof that he isn't really? Does Chamath Palihapityia overhype his SPACs at the expense of retail investors, or is he truly a man of the people? Let us know what you think in the comments. Alright guys, that wraps it up for this video. If you like the content, make sure to like and subscribe to the channel so you don't miss future videos. Also check out our second channel, WSM Research, and check us out on Instagram and TikTok. In the meantime, thank you guys so much for watching. Wall Street Millennial, signing out.